Welcome to today's presentation on Western Union and Wells Fargo. Our presenter for today is Barbara Hawkins, an MBA student at Concordia University, Nebraska. Barbara resides in Western PA and currently is employed as a manager of risk investigations for a mid-sized bank. The agenda for today's presentation will include a discussion of each financial institution, including recent regulatory concerns. So let's get started. What happens when revenues overrule compliance? Today we explore two companies, Wells Fargo and Western Union, who recently received penalties for insufficient compliance programs or regulatory violations. Both companies have a long-standing history dating back hundreds of years, yet what went wrong? Did the tone at the top change? Did greed overtake compliance? A review will be conducted of each business using the 7 core elements of a compliance program and examine steps that should be taken to overcome gaps in current policies and procedures. Starting with Western Union businesses comprise a network of approximately 500,000 agent locations in 200 countries and territories worldwide. U.S. anti-money laundering rules classify Western Union as a money service business, which requires them to have an effective AML program in place to prevent the company from being used to facilitate money laundering and the financing of terrorism. The Financial Crimes Enforcement Network, or FinCEN, has assessed a $184 million civil money penalty in January of 2017 against Western Union's financial service. Western Union willfully violated the Bank Secrecy Act anti-money laundering requirements by failing to implement and maintain an effective risk-based AML program and by failing to file suspicious activity reports timely. FinCEN's penalty is in conjunction with actions by the U.S. Department of Justice and the U.S. Federal Trade Commission. The acting director of FinCEN, Jamal El-Hindi, states, "Money transmitters, large and small, play a critical role in the movement of legitimate funds around the world, and they are also vital assistance to FinCEN and law enforcement in thwarting illicit activity. As such, it is imperative that they maintain appropriate safeguards to keep illicit actors from abusing their products and take to heart that not all business is good business." U.S. Attorney Wilfredo Farrow singled out the tone from the top as part of a deep cultural problem that dismissed AML practices in favor of profits. He's quoted as saying, "Western Union, the largest money service business in the world, has admitted to a flawed corporate culture that failed to provide a check and balances approach to combat criminal practices. Western Union's failure to implement proper controls and discipline agents that violated compliance policies enabled the proliferation of illegal gambling, money laundering, and fraud-related schemes." One example of Western Union's misconduct is one of their agents actively structuring payments to human trafficking perpetrators in China to avoid BSA reporting requirements. A Western Union business in Los Angeles sent over $310 million to China in a span of 5 years that was illegally structured and transmitted using false identification. The FBI stated that rather than monitoring their high-end Western Union agents to ensure they were operating with compliance, they rewarded them for their lack of regard to compliance and illegal practices. Using the federal sentencing guidelines of a compliance program, what should Western Union have done? The guidelines outline that a compliance program should have standards and procedures, organizational leadership and culture, training and education, monitoring, auditing, and evaluation of program effectiveness, which can include risk assessments, having performance incentives and disciplinary actions, appropriate remedial measures, and reasonable efforts to exclude bad actors from managerial ranks. Western Union is a prime example of a company that had many of the core fundamentals on paper, however, did not promote a culture to align with said guidelines. Next, we will take a look at Wells Fargo, which was founded in 1852 and is known for that stagecoach image of carrying gold across America. Today, Wells is a diversified community-based financial service company with $1.9 trillion in assets. Wells Fargo has 7,950 locations, 13,000 ATMs, with internet and mobile banking. Wells offices are in 37 countries and territories to support customers who conduct business in a global economy. 2018, Wells Fargo was fined $1 billion by the Consumer Financial Protection Bureau, the CFPB, as punishment for the banking giant's actions in its mortgage and auto loan businesses. This is the largest action in CFPB history. Wells Fargo's conduct caused and was likely to cause substantial injury to customers, said the agency. Wells Fargo's violated the law by charging some consumers too much over mortgage interest rate lock extensions and by running a mandatory insurance program that added insurance costs and fees into some borrowers' auto loans, according to the CFPB. The new federal action against the bank comes less than 2 years after Wells Fargo was fined $185 million over what was called the widespread illegal practice of secretly opening unauthorized deposit and credit card accounts. Wells Fargo was also punished by the U.S. Office of the Comptroller of Currency over its risk management practices, with the agency collecting a $500 million penalty as part of the fines. Besides treating its customers unfairly, the OCC said that Wells Fargo had failed to maintain a compliance risk management program that was appropriate for its bank of its size and complexity. The failure, according to the OCC, led Wells Fargo to engage in reckless, unsafe, or unsound practices and violations of law. What preventive measures could both these businesses have taken? For both Wells Fargo and Western Union, how could they have lowered their level of risk and keep stakeholders happy? Trust is vital to any stakeholder. A company's good name and the trust of stakeholders are two of its most important assets. Protection of a company's reputation can be achieved through the increase of employee engagement in creating a workplace where ethical conduct is the norm. There are 5 guidelines that can help lower the risk of ethic violations in companies. Honestly assess your needs and resources, establish a strong foundation, build a culture of integrity from the top down, keep a value focus in moments big and small, and reevaluate and revise as needed. In conclusion, both these companies have a long-standing history and are known across the globe. As global companies, it is important they both set the standard in the financial market. The financial sector is based heavily on trust. Albert Einstein is quoted as saying, "Whoever is careless with trust in small matters cannot be trusted in important matters." Trust and ethics are important matters for both companies. I hope that both organizations reestablish stakeholder trust and trust within their own organization to move forward into strong, ethical companies.